What if I told you there's a fund paying a 112% yield, and the investors who held it for the past year still lost money? That's not a typo, and it's not a scam. It's PLTY, and it's one of the most misunderstood ETFs in America. PLTY is the YieldMax PLTR Option Income Strategy ETF. It launched in October of 2024, charges just over 1% in fees, and has grown to roughly $350 million in assets. Its job is simple: turn Palantir, one of the hottest AI stocks on the market, into a weekly paycheck. And right now, Palantir is on fire. The stock rallied double digits this month after announcing a sovereign AI partnership with NVIDIA, and retail investors can't get enough of it. PLTY rides that wave, and every single week, it pays out cash. The most recent distribution was about 30 cents a share, week after week after week. Here's the machine under the hood. PLTY doesn't actually own Palantir stock. It runs what's called a synthetic covered call strategy. It uses options to copy Palantir's price moves, parks its cash in treasury bills, and then sells call options against that position. Selling those calls generates premium, and that premium is where your weekly income comes from. But here's what they don't tell you in the marketing: that 112% yield is not a return. Over the past 12 months, PLTY investors actually lost about 10%, even after collecting every single one of those weekly distributions. Read that again. Triple-digit yield, negative total return. Why does that happen? Because selling call options caps your upside. When Palantir rockets higher, PLTY only captures a slice of the move. The calls give the rest away. But when Palantir falls, PLTY eats almost the full loss. Add that up over a volatile year, and the math turns ugly. Huge income, shrinking share price. The yield is paid out of the same bucket your capital sits in. To be fair, the full picture is more balanced. Since launch, PLTY has averaged over 50% a year, because Palantir itself has been a monster. The fund's results are chained to Palantir's, minus the capped upside, plus the income. When the stock trends up gently, PLTY shines. When it whipsaws, PLTY bleeds. So who is this actually for? Someone who already wants Palantir exposure, prioritizes cash flow today over growth tomorrow, and genuinely understands they are renting out Palantir's upside in exchange for weekly income. If you're a long-term believer in the stock itself, just buying Palantir will probably serve you better. And remember, a triple-digit yield on paper means nothing until you subtract what the share price gives back. If this changed how you think about yield, hit like and subscribe for a new ETF breakdown every week. And answer me this in the comments: would you accept a 100% yield knowing you could still lose money? I read every reply.